So far, nobody else is trying to join, so I guess we will begin.
All right, good. Ramon, let's get started.
Okay. Hello, everyone, and thank you for attending the San Francisco Public Library's program Tax Update, Getting Ready for Tax Season, presented by Lawrence Pond. Before we begin, make sure does everybody see the new slide? Okay. Before we begin, I would like to share that the San Francisco Public Library Commission acknowledges that we occupy the unceded ancestral homeland of the Ramaytush Ohlone peoples, who are the original inhabitants of the San Francisco Peninsula. For more information and the full text of the land acknowledgement, please visit our website at sfpl.org. We're really happy that everyone here is joining us virtually, but we would like to encourage people to visit the Business Science and Technology Center on the 4th floor of the main library, if you have an opportunity to do so. Also, please find the resources and programs we offer by visiting our website and navigating to the Business Science and Technology Department page by clicking on either the Research and Learn or Library Location and Hours tabs, where we list our databases, upcoming programs, and other resources provided by SFPL and external partners, such as Advisors Give Back, where you can virtually meet one-on-one with a certified financial planner for free if you meet the qualifications listed in the description. We also offer one-on-one meetings with smart money coaches and certified financial planners virtually, over the phone, or in person on the 4th floor of the main library. Please refer to our website on information on how to register and book an appointment, or you can always just reach out to us and we will be happy to book an appointment for you. So thank you everyone again, and please welcome today's presenter, Lawrence Pond. Lawrence is a certified public accountant, personal financial specialist, certified financial planner, enrolled agent, United States Tax Court practitioner, and accredited estate planner in Redwood Shores, California. Mr. Pond has been in practice since 1986 and speaks regularly to tax professionals and financial advisors on the latest tax planning and preparation topics nationally. Mr. Pond teaches Accounting 181, Individual Income Tax at College of San Mateo. Mr. Pond received his BS in Business Administration from UC Berkeley and MS in Taxation from Golden Gate University in San Francisco. And now I'd like to turn it over to Lawrence Pond. Thank you very much. Sorry, I'm not hearing your audio.
Okay. Can you hear me okay now?
Perfect,
okay,
thank you.
Turn off your share. I'll start my share.
Okay.
Slide deck here. And boy, has there been a lot going on. And thank you for the introduction, Ramon. At the bottom of your screen here on Zoom, you have a chat function. And Ramon, is this also being broadcast in the auditorium at the library? So are there people sitting in there also?
Not today. That was for our financial planning.
Okay, good.
Yeah.
All right. So yeah, I've been involved with Financial Planning Day since we started it over a decade ago at the San Francisco Main Library. It's a wonderful experience. And then we had to do it virtually during the pandemic, and I'm looking forward to the time we can do it again live. It's been a lot of fun. I always give the tax presentation in the auditorium and love enjoying meeting people on the one-on-one consulting. It's been great. So at the bottom of your screen, you have the chat there. Ramon will be monitoring it as we go along. And Ramon, there's also the handout, right? Are you going to post a link for the handout for everybody? So that'll be great.
Yes.
So, okay, Ramon will do that. All right, a little about me. Also, I'm making a plug for the College of San Mateo. The first day of class starts on Tuesday. It's Tuesday at 6 o'clock. Great class for you to learn about income taxes. If you want to get into the income tax field, I think that's a great course to start with. And I'm a big proponent about the tax profession. Been doing it for this is my 37th year doing this, and I love it. We have a lot to talk about today. We only have an hour of time, so I might not go into everything in deep detail. So there's some portions in my presentation I'll be skipping over, but if it's really important to you, we can talk about it after 3 o'clock. So today we have a number of things to talk about. Late breaking news. Taxes change on a daily basis, literally on a daily basis, or actually on an hourly basis. There's always something changing in taxes. So, if you meet someone that says, I know everything there's to know about taxes, that person's lying. We'll talk about tax forms, the update to the forms. There's been some changes to the forms. Inflation adjustments. What happened in 2022? 40-year high in inflation. Oh my goodness. So that made a lot of differences in what's coming up for a lot of numbers for taxes. We had a tax bill last year called the Inflation Reduction Act. So we'll talk a little bit about that. And also another bill that went through was called the Omnibus Bill that passed at the very end of December, which included Secure 2.0. We'll talk about that. And then our last topic will be California. We're like the 6th largest or 5th largest country in the world. If we were a country, big economy, and California does not conform to federal taxes. So even though there might be some changes on the federal tax law, it might not affect California. And California has their own set of rules too. So we'll talk about that. So what's the big news? This is late breaking news. This came out yesterday. And I was born in San Francisco and I lived there my whole life. And for the first time, my backyard flooded, and my wife's flip-flops were in our backyard, just floating in the water. So I've never seen that happen before in my life. And drive around, there's trees that are falling over, right? There's a big hole in Highway 92. Oh God, that's close. There's a whole bunch of sinkholes everywhere. So drive carefully. You don't want to break your car. And saw in the news, someone's Toyota Sequoia fell into a sinkhole in Daly City. So a lot going on here. Some offices are closed because they got flooded. And so a lot of us were affected by this storm. And it hasn't rained in a few years, and we don't know how to deal with it. And this has been extraordinary. So what is all about here? Well, the IRS and the state is giving us filing and payment relief because of issues where your house is flooded, your business is flooded, or a tree fell on your house. Yeah, so it's all that in the news. This tree just slammed through someone's living room and flattened their house. Saw a car that was totaled by a tree, so that happens. So our tax season was supposed to end on April 18th. Well, our tax season will really effectively end on May 15th. So basically, this relief means that any deadlines that occur on or after January 8th, that's when the rain started coming down, January 8th, but before May 15th, 2023, you got till May 15th to file your individual tax returns. That's Form 1040. Your business return filings that we do between March 15th and April 18th, that's May 15th. Estimated payments. So the fourth quarter estimated payment is due January 17th. Well, you don't have to pay that until May 15th. The taxes that normally be due on April 18th, you pay that on May 15th. So estimated payments. So pay on or before May 15th, 2023. If you pay by May 15th, then it's still treated as timely, no penalties. With this extension, you've got an extra month to make your IRA contributions. It would have been due on April 18th for 2022. You have till May 15th to make your IRA contributions. Same thing with your health savings account. So when you get your 5498-SA, let's say you only contribute $2,000 to your HSA, but the maximum is $8,300 if you're over 55 years old. You can top it off by May 15th. Don't wait till May 15th, but you got till then. Quarterly payroll excise tax returns normally due January 31st, 2023 and April 30th. They extend to them. However, you still have to make your tax deposits. Tax deposits for payroll still has to be made in January. So that one little bit. So, if you have payroll, talk to your payroll service about this. This was just announced literally yesterday. Now, what the franchise task force says, if you're in collections with them, you have some issues there, they're going to suspend mailing of collection notices for the next 30 days, beginning January 13th. So, which means if you owe the state money, they're sending you collection letters. You're not supposed to get them until after February 13th. Here's the list of counties. Now, I think I counted 41 counties here. How many counties are in California? I think we have 53 counties, I think, right? Wouldn't it be easier for them to say all of California except for these 17 counties? And if you look at the list of counties, you got San Francisco, you got San Mateo, you got Alameda, you got Contra Costa. It's basically most of California. Now for Southern California, we got Los Angeles, we got San Diego here. Yeah, San Diego's here. We got Fresno, right? Fresno was hit pretty hard. And then the Tahoe area, all the counties around there. So pretty much most of California. I didn't look at the list of who's not here, but most of California, right? So this is kind of new for me because we never get this kind of relief. If you live in Florida or in the Gulf Coast, you got hurricanes all the time. Or if you're in Texas, Oklahoma, you have tornadoes. So to me personally, this is kind of new because we normally don't get these natural disasters. But here we go, tax relief. Here's the links to the announcements. The first was the IRS announcement. You can go to that link. It's got a little more details on that. The second link here is the California announcement that just literally came out yesterday from the governor's office. So not just the relief in filing and payments, there's also if you suffered a loss. So the tax law changed back in 2017 that says if you have a casualty loss because something happened like a fire or in our case a flood or something like that, had to be part of a nationally declared disaster. Well, it is now. If you do have a loss that's not covered by insurance, you can claim a loss in your tax return, either on the 2022 tax return or on the 2021 tax return. So you got to do the math to see which gives us the better answer. That's claim of Form 4684, casualties and deaths. Now, if you want to claim a loss, you have to enter the FEMA disaster declaration number on the form, and that's FEMA-3591-DR. That way, the IRS will know which loss you're claiming. If you leave it blank, it'll be rejected. But this is what's going on here, and I think it's is it raining now? Yeah, it could be, right? So hopefully our reservoirs get filled up and all that good stuff happens. So that's the late breaking news of the storm relief we have. Now let's talk about the 2022 tax forms, which is the returns we're working on right now in 2023. We just got the announcement from the IRS that tax season opens on January 23rd. So they won't start processing tax returns until January 23rd. Now, for some reason, California says we'll take it on January 17th, but you got to get your federal first before you can figure out the California. But anyway, January 23rd, if you're an eager beaver, hold on till then. Well, the question is 22, are these tax returns going to be easier than the 21? Because 21 was pretty rough, right? And so was 2020 because we had the pandemic. Tax laws were changing on a weekly basis or a daily basis. And we always had a new guidance, new laws. There's a flurry of laws that kept flying at that time and a lot of changes. Well, the changes we saw last year in 2021 was the economic impact payments, also known as stimulus payments. None were paid in 2022. In 21, we also had the advanced child tax credit payments. So if you had qualified children, you would have got a check ahead of time from the IRS, starting in July of 21 to December of 21. That ended in January of 22. So we're back to the so-called normal child tax credits. That's $2,000 per kid for under age 17. Also, the enhanced child dependent care expenses were not extended. So we're back to the $3,000 per person with a $6,000 maximum. So that's for your kids or your parents or whatever. And the other change on the 2022 forms is last year and the year before, we had charitable deductions for non-itemizers, $300 for singles, $600 for married filing jointly. That was for 21. In 2020, it was $300 for everybody. So that is gone. Okay. So if you're not in those counties listed in an earlier slide, the normal tax deadline's April 18th. You're saying April 18th, why is that? Well, April 15th is a Saturday, right? April 17th is Monday, but it's a holiday in Washington, D.C. It's Emancipation Day. So because of that, April 18th is the due date. Now, for the storm relief, you do not have to be damaged or affected by the storm. You just have to reside in the county. Now, it's not just you, but also your tax preparer. If your tax preparer is located in those counties, you are covered. You might live in Tulsa, Oklahoma, but your CPA or enrolled agent is in San Francisco. Well, they're covered by this relief. So it's where your records are located, where your tax preparer is located, and where you're located. You don't have to prove that you were affected by the storm. I do have a picture of my backyard, my wife's shoe floating in there. So I do have some proof of that. So it's kind of interesting.
So you don't have to have proof?
All right. So, okay. So if you look at the front page of the 1040, and I don't really have time to go over the form in detail, so I'm not going to show you a picture of it, but there's some changes on the front page of the 1040. So when you take a look at it, what's new? Well, if you look at your name, address, social security number, what's right behind that? There's a section called digital assets. Now, before it was called virtual currency. Now it's called digital assets. This used to be buried like 4 pages into the tax return. A couple of years ago, the IRS moved it to the front page of the return. So do you think this is an important question? Well, the question is, at any time during 2022, did you A, receive as a reward, award, or payment for property or services, or B, sell, exchange, gift, or otherwise dispose of a digital asset, or financial interest in a digital asset? And digital assets are virtual currency, cryptocurrency, NFTs, whatever you call those things. So don't lie, because if you lie, the IRS already knows anyway. They already know if you have cryptocurrency because they have all the records. They did John Doe summons to all the exchanges. Coinbase is the big one here in San Francisco. There's Kraken. There's a whole bunch of ones I never heard of. They have all that information. They have that information. And the IRS knows about it because they will send you a letter saying, hey, you know, we know you got cryptocurrency, but you didn't report in your tax return. You better do something about it. That's one of the first letters you get. If you ignore them, they'll send you another letter saying, we know you have cryptocurrency. And by the way, you owe us taxes on that. Here's your bill. So, you know, watch out for that. Now, let me know if any of you are invested in FTX that went bankrupt. So there's some interesting things going on there. So, you know, personally, I don't invest in things I don't trust or understand. So anyway, it's a big deal, and we're going to see more and more and more regulation on it. Earlier or last year, how many Super Bowl commercials did we see on cryptocurrency, right? And how many of those are still in business today? So just watch out for that. Okay, the other thing is student loan forgiveness. If you have any student loan forgiveness for federal purposes, it's not taxable. In August of 2022, President Biden announced that he will forgive $10,000 of student loan debt or $20,000 of student loan debt if you had a Pell Grant. This only applies to federal loans. So if you refinance your student debt with private loans, sorry, you don't get this relief. It's on hold right now at the Supreme Court. The Supreme Court is going to rule if the president has the authority to do this. And this came from the 8th Circuit Court of Appeals. We should know by June 30th of 2023. So student loan payments are suspended until June of 2023. But take a look at what your loans are and just be prepared that in July, you're probably going to start making payments again. And we'll talk a little bit more about student loans a little later when we get to the California section. Okay, so the other thing for 2022 is if you get your health insurance through the Affordable Care Act, or in California, we call it the Covered California, make sure you reconcile any advance payments of the premium tax credit. This is what causes the biggest notices and problems with the IRS. So it's important to get the form 1095A. If you don't get it in the mail, get it from the Covered California website. Also, health coverage reporting for federal, the mandate is still there. It's just not being enforced from the previous administration, but California has a mandate. So make sure you get the 1095C to prove that you have health coverage. If you can't prove you have health coverage in California, you have a penalty. All right, inflation adjustments here. So record high inflation last year, and hopefully for 23, it's going to lighten up a little bit. Let's cross our fingers on that. But the IRS has the authority to update their numbers based on inflation, standard deduction, the tax brackets, the alternative minimum tax exemptions, flexible spending arrangements, the annual gift exclusion, and the lifetime basic estate exclusion. So those are the things that have changed. All right. So standard deduction. What's the standard deduction? Standard deduction is the amount of income that you don't have to pay taxes on. So for example, if you're single for 2022, the standard deduction is $12,950, which means no tax on the first $12,950. Well, for 23, it's a $900 increase. I think that's the biggest in history, $13,850. So if you're single, you make $12,000, your taxes are zero. If you're married filing jointly, it goes from $25,900 to $27,700. So for the first about $28,000 of income, there's no tax. So that's an increase of $1,800, record amount. So that should help reduce your tax bill with the higher standard deduction. Also, the tax brackets have ratcheted up because of the inflation and all that. I think a lot of us are probably in the 22% bracket. That's at 44,000 to 95 if you're single, 89 to 190 if you're married filing jointly. But look at this here. I mean, I hear people come, oh, I'm in the top tax bracket. I said, no, you're not. They just think they are. The top tax bracket is 37%. You don't get there until you're over 578,000 if you're single, 693,000 if you're joint. If you're in the top tax bracket, congratulations. And I think we had one, not a big winner, but someone got most of the numbers on the lottery last night. He bought the ticket at the Chevron in Burlingame. So we'll see who that is. That person should be in the top tax bracket if you took it all at once. So here's what this means here. So let's say you're single, your income's 175 grand. In 2022, that puts you in the 32% bracket. Because of the inflation adjustments, you're now in the 24% bracket. And so I just wanted to see what the difference in income this looks like. So if your income's 100 grand, you're single, that means your tax bill is $508 less. Verifying jointly, if you're 100 grand, your taxes are $245 less. So, there's some concern about refunds this year. Is it going to be higher or lower than last year? It could be lower because a lot of those COVID relief amounts are gone. And also, the withholding tables will be adjusted for these inflation amounts. Now, are the withholding tables perfectly adjusted? Of course, they're not. So you might want to double check your withholding to make sure you're tracking appropriately. Are you having enough withheld or you're not having too much of a refund? The alternative minimum tax, that's a second tax system we had. It's a flat tax, but the exemption's been significantly increased. So very few people pay this tax now. For singles, at 81,000. Married filing joints, 126,000. But why is this relevant? Well, we're here in the Bay Area. We have a lot of startups. People work for startup companies, and they get incentive stock options, ISOs. And with the higher exemption, we get some opportunity to do what's called break-even tax planning, which means how many shares can I exercise without incurring the alternative minimum tax. So that's some planning we can do, because some people exercise too much and boom, they get stuck paying an additional tax. Capital gains rates, look at these increases here. So for you have three choices of tax rates for capital gains. It's either 0%, 15%, or 20%. I think most of us are probably in the 15% range. But look at this wide range here. For if you're married filing jointly, it's from $89,000 to $553,000. So what does this apply to? This applies to capital gains, long-term capital gains. That's for securities you hold for at least a year, like a stock, a mutual fund, an ETF. If you held it for at least a year, you have a gain, you pay a more preferential rate. It's a better rate than the ordinary tax rate. The ordinary tax rates, are higher than that. You got starting at 22, goes all the way to 37%. So that's why capital gains are important. But also, if you're towards the lower end here, you can have $89,000 to taxable income, and your tax could be zero because of the capital gains rate. This also applies to qualified dividends. So if you get dividends from U.S. companies, that's taxed at this preferential rate. It's a pretty good deal here. So don't forget to take advantage of that. All right, specialty allowances. So the gift exclusion went from 16,000, that's for 2022, to 17,000. So what that means is you can give me $17,000 without any gift tax filing. That's what it's all about. So if you decide to give someone a lot of money, if it's more than $17,000, you need to file what's called a gift tax return. That's a Form 709. But why is this relevant? I like to recommend the Super 529 contribution. These are aimed at grandparents. A Super 529 contribution is 5 years worth of gifts into a child's 529, which is used for college, and it grows tax-free. Big fan of them. So for 2022, 5 times 16 is $80,000. For 23, 5 times 17 is $85,000. So you can sock away $85,000 into a 529 that grows tax-free to pay for college. It's a whole lot better than buying stuff for the grandkid. It's better to buy an education for them, right? You get a whole lot more bang for your buck. What's the catch of the Super 529? You have to outlive the gift by 5 years. So grandma, she does it today. She has to outlive it by 5 years to have a complete gift. If she dies during those 5 years, then she has what's called an incomplete gift, but something certainly worth considering. The next point is the foreign earned income exclusion. That's for people who are U.S. citizens or residents who are working overseas. You're working overseas, you can exclude the first $120,000 of your income from taxes. So if your salary is less than that, your U.S. tax is zero. For 2022, that's $112,000. So this is I've never seen it increase by $8,000. That's a big deal. Now, depends on which country you go to. Some countries have higher taxes than us, such as Sweden. Some taxes have lower taxes like us, such as Saudi Arabia, which is zero. So, it depends on which country you go to, but it's an interesting situation. We're in a global economy. Taxes shouldn't be a deterrent for taking a job over there. If you adopt a child, the tax credit's gone up from $14,890 to $15,950. And the basic tax exclusion from inheritances, for 2022 is $12,060,000. $12 million, I mean. I thought it was going to hit $13 million. Pretty darn close. $12,920,000. So that means if your estate is less than $12,920,000, there's zero estate tax. As a matter of fact, most Americans don't pay estate tax. I know the politicians call it the death tax and all that. They think it's a big deal. Don't listen to the politicians when it comes to taxes. They have no idea what they're talking about. And they always put up some really crazy stuff in Congress. So, don't listen to your Congress member, listen to us. However, with this higher exclusion, throughout the United States in 2020, the last set of statistics we got, only 1,500 Americans paid estate tax. 1,500. What do we have? 500 million people in this country, something like that. So very few Americans pay any estate tax. But this is important for tax planning, because why do I mention this? Is because the way the law is written, In 2026, it's going to drop back to the old amount, which was $5 million, indexed for inflation, which we predict would be about 7 million. However, some members of Congress wants to drop it back to 3.5 million. And when Obama was president, in his budget proposal, he wanted to drop to $3.5 million. Other members of Congress, such as Bernie Sanders, wants to make it $600,000, which is what the amount was over 20 years ago or so. So, some politicians don't think we should give inheritance to our family members. So anyway, that's what's going on there. So that's why it's important to consider this. Also, if you're married and you lose your spouse, you become a widow or widower, there's a concept called portability of the deceased spouse and use exemption. It's important to consider that because we don't know what the future exemption is going to be. If you have questions about that, you can talk to your estate planning lawyer about it for more details. Social Security. I don't know if you remember a few years ago, we had 0% increase in Social Security because we had no inflation. Well, in 2022, it's a different story. We've got massive inflation. And in 2023, the benefits are going up 8.7%. In 2022, went up 5.6%. Those are pretty big deals because before that, we saw 1% increases, 1.3% increases, or zero. So 8.7% increase in Social Security. If you're working, you got to pay Social Security tax. So for 2022, you kept paying Social Security tax up to $147,000 of wages and self-employed income. 2023, that's $160,200. So your Social Security, your FICA contribution goes from $9,114 to $9,932. That's like what, an $800 plus increase in Social Security tax you'll be paying. So budget accordingly here. Now, not all the numbers have been indexed for inflation. Some have to be changed by an act of Congress. And, it's kind of hard to get Congress to act on anything. So you wonder why some numbers have not changed. It's because not everything's been indexed for inflation. Okay, I'm moving pretty fast here. Let's talk about retirement plans. So because of the high inflation, the amount you can put away in your retirement plans have also gone up. For your 401k, 403b, 457 TSPs, the maximum goes from $20,500 to $22,500. If you're over age 50, the catch-up goes up from $6,500 to $7,500, which means if you're over 50 years old, you can put 30 grand into your retirement account. Pretty good deal. IRAs contributions have gone up. It's been $6,000 for 2023. It's $6,500 now. The catch-up contribution is still $1,000 if you're over age 50. That has been changed to an act of Congress, and it has changed. It has changed because the president signed the omnibus bill. That was the $1.7 trillion bill. I'm not going to go through this in detail due to time, but you can look at this on the slide later on. This is the deductible traditional IRA contributions. It's based on your income and if you're participating in a retirement plan or not, if you're married or single, but the thresholds have gone up, so you notice the increases here. That's a pretty big deal. The other I think is a big deal is Roth IRA contributions. The phase out ranges for single, it goes up from 129 to 138. For married and joint, it's 204 to 210. I think a lot more people are going to be eligible to contribute to a Roth IRA because I keep hearing people say, oh, let's do a backdoor Roth or whatever. I said, well, before you do something that complicated, how about just a simple contribution? That might be a whole lot easier. The income limits have gone up. The savers credit, you got to take advantage of it because you get a credit on your tax return. What's a credit? Credit is a dollar for dollar reduction in your taxes. If you participate in your 401k plan, put money in an IRA, you get a tax credit. And the income thresholds have gone up. So that's a big deal there. Well, let's talk about investing here. So for the past few years, I didn't really talk about I-bonds because if you go to the Treasury Direct website to look up the interest rates on I-bonds, it was zero It was 0, 0, 0. So why invest in something paying 0? Well, in 2022, because of high inflation, it's gone up. And then in the second half of 2022, it was paying 9.62%. Wow. And through October 31st, you could have bought it on October 28th, which is the Friday before, you would still get the 9.62% for 6 months. Well, it adjusts every May and November. So on November 1st of 2022, it adjusted to 6.89%. So we'll see what the rate's going to be in May of 23. Will it go up? Will it go down? We'll see how the Treasury computes that. You can buy these. You have to buy them electronically through treasurydirect.gov. The most you can get is $10,000. So you get 10,000, your spouse can get 10,000, each of your kids can get 10,000. You can get an extra $5,000 with your tax refund. So you look at Form 8888 and check the box saying, hey, I want $5,000 of I-bonds, and you'll get them as paper bonds, $5,000. So you'll say, well, Larry, my refund's only $2,000. How do I get $5,000? Write a check to the IRS for $3,000 on a 1040 ES. That's an estimate payment that's treated as a payment. So 3 plus 2 is 5,000. You'll get the $5,000 refund. Now, they're great. They're risk-free. There's a 12-month lockup period, so you can't cash in for 12 months. So it's not for your everyday money. Also, if you cash in before 5 years, you lose 3 months of interest, but it pays for 30 years. It's federal taxable, state tax-free. You only pay the taxes when you cash them in. You can possibly use them to pay for college tuition, tax-free. You got to meet certain requirements for that. But because of the high inflation and interest rates, they might be worth considering. If you work for an employer where you can have payroll withdrawals to buy I-bonds, sign up for that. I mean, I'll keep doing it until the rates go down again. Pretty good deal. More late breaking news, Form 1099-K. This was announced in 2021 where they changed the rules for 1099-K. That's for, if you're paid by a credit card, you're paid by Venmo, you're paid by Uber, Lyft, Airbnb, Etsy, or whatever, right? Well, the old law was that you only got 1099-K if you had less than 200 transactions or less than $20,000. Well, the law changed that for 2022, the threshold is $600. You'll get a 1099-K. Well, December 23rd, the IRS says, okay, we'll put a hold on this law for 1 more year. This will apply next year. So the $600 rule. Now, during the Omnibus Bill debate, the Consolidated Appropriations Act, some members of Congress wanted to increase the threshold. And I think the magic number was around $10,000 or so. So we'll see what happens this year if Congress is going to step in and change it. But, it applies for any provisions of goods or services. It's for your business. It's not going to apply for any reimbursements like, let's go to dinner together and you Venmo me some money to cover the cost of dinner. That's not going to matter. Charitable contributions, you PayPal some money to your favorite charity, or you just paying your kids. It's like, I think the kids don't believe in cash. They do it this way, but you have to let the provider know that these are personal, not business. So I guess they're working on the software. All right. So 1099-K, hot topic. People are stressing out about it. All right. The Inflation Reduction Act was a big tax law that was passed last year. Passed the House, barely passed the Senate, 51-50. The bill, if you look at the bill numbers, HR 5376, you go, hey, that sounds familiar. Yeah, it does. It's the Build Back Better Act from 2021 that passed the House, but it died in the Senate. Came back this year, but significantly reduced because of the shortage of time. I'm not going to go over the deep detail about it, but basically the bill has tax increases IRS funding, a lot of green climate change, and then Medicare. So that's what this bill went into. I'm going to buzz through this pretty quickly here. Tax increases, it's not going to affect many companies. Some people say it only affects about 1,500 companies because you have to have over $1 billion of revenue. How many billion-dollar companies are there? And there's been so many concessions that I don't think it's going to make that big of a difference. Stock repurchases. If you saw the news, a lot of companies will buy back their stock, and it really improves their financial situation. So Congress wants to tax it. What it means to you is companies might not want to buy back their stock. They might want to pay more in dividends. We'll see if that happens. IRS funding. The IRS got $80 billion of funding because they've been underfunded for the last decade. And there's a tax gap. However, the House Republicans have tried to repeal this. So I hope not, because I used to work for the IRS in 1984, and I think they're still using the same computer. So I think they need to update their computers, get better software, get more people. Because if you try calling the IRS, they're not answering the phones. And we want a good functional IRS. I need a good functional IRS because we all need to work together. So yeah, I'm a little annoyed about what the House Republicans are trying to do, but it's not going to happen. Okay, so we have the energy efficient home improvement credit. So that replaces the old law. It's $1,200 of annual credits a year if you buy certain appliances. It's $1,200 per year, not a lifetime amount. So you might want to do some tax planning with your home improvement planning, but I don't recommend getting tax advice from Home Depot or Lowe's or whatever, okay? But anyway, this is for getting windows, doors, insulation, energy efficient HVAC, and all those sorts of things. I'm not going to go into detail here because, boy, is our time going fast together here. And I do want to save some time for questions. The clean energy credit was a retroactive change because the credit dropped to 26%. Now it's 30%. That's for solar electric, solar heating, fuel cells, wind, biomass, and geothermal energy. So it's 30%. And starting in 2023, you also get a tax credit for energy storage. That's a battery. And it doesn't have to be connected to solar power because we're in California, right? We get these PG&E shutoffs. So a lot of people have bought the batteries in case they turn off the electricity on us. You get a 30% credit for that. All right. Okay. The other one is the cars. Clean vehicle credit. Again, don't recommend getting your tax advice from a car dealer, but the new law is a little bit different. They took out the 200,000 vehicle limit because once you sold 200,000 cars, you didn't have the credit. So that applied to Tesla and General Motors. Well, that doesn't apply anymore, but there's new rules that apply. The cars have to be assembled in North America, and there's the battery has to come from, the battery parts have to come from either the US or a friendly country. Unfortunately, most of it's coming from non-friendly countries such as China and Russia. So they're trying to get that industry going here in the United States. So hopefully we can get the lithium, cobalt, and all those things here. But there's MSRP limits. So for cars, it's for cars of 55,000 or less. So check to see what cars cost less than 55,000. Or SUVs and trucks, they have to be less than $80,000. Also, income limitations. If you're single, your income has to be 150,000 or less. And for married, it's 300,000 or less. And it's for the current year or the previous year. So if you met the AGI limit in the previous year, you're good. But if you didn't last year, you have to see if you qualify this year. So there's the MSRP and a modified adjusted gross income limits. This is for last year, plugins. There's helpful websites to check to see if the car you're interested qualifies. So I have a link here to the Department of Energy website. It's got a nice grid of cars, and they show you how much the credit is, what it qualifies for. You can also go to the Department of Transportation, the VIN locator. That's the set of numbers in your car, and they'll tell you where your car was assembled because it's kind of confusing, right? Cars are made all over the place. But North America is Canada, United States, or Mexico. A lot of cars are made in those three places. Also, your door, you open your driver's side door, there's a little sticker that says where your car was finally assembled. The IRS has a really good website. You go to irs.gov, type in IRC 30D. It'll give you a very comprehensive website on guidance on the electric vehicles, because the rules are changing every day. We just got some more changes the other day because who was complaining? Was it Nissan? Was it Nissan? It was one of the manufacturers saying, I think you're violating the trade agreement if you say the cars have to be made in North America. I think Volkswagen was complaining or something like that. So changes every day. So the IRS updates that for us. Also, under the old rules, you only got the credit for new electric cars. Now you can get it for used electric cars. The credit's up to $4,000 or 30% of the purchase price of the vehicle. The limit is $25,000. So the used car can't cost more than $25,000. It's got to be 2 years older. So for 2023, it's got to be 21 model or older to qualify. It's got to be less than 14,000 pounds, had to qualify as an electric vehicle. And there's also income limits, 75,000 for single, 150,000 for married filing jointly. Now, with these electric car credits, you can get it directly from the dealer, which means they can reduce the price of the car by the credit if it's 7,500 or 4,000. However, if you don't qualify, you got to pay it back on your tax return. So it's up to you if you want to claim it or not. My general advice is don't. You'll get the credit on your tax return. I'd rather do it that way. And again, why do I want to give my personal information to a car dealer, right? There's the refueling property credit. That's for putting either an electric charging station or a natural gas plug in your garage to plug in your car. You get a 30% tax credit for that. As part of this, we have home energy rebates. I am not going to talk about it here because it's administered by the state, and I still haven't seen the state of California issue anything on this yet, but it's meant to give rebates for buying appliances and for retrofitting your homes, and it could be up to $14,000, but your income has to be below a certain amount. So I'm going to buzz right through these slides because you can read these when you get the PDF. And waiting for California to give us some more guidance on that. The Inflation Reduction Act also extends the affordability percentages for the Affordable Care Act. So more people will get credits for their health insurance. Medicare, we finally changed the law. There's a law written by a senator a few years ago that says Medicare cannot negotiate drug prices. It's like, who voted for that? Well, anyway, now we finally can. It's not happening overnight. It's going to take some time. You get the $35 cap on insulin only if you're on Medicare. And then the prescription drugs, the cap is $2,000 only on Medicare. So for those of us who are not on Medicare, we don't get that. The drug negotiations don't start until 26. That's only 10 drugs. And then 27 is 15 drugs. And by 29 is 20 drugs. I hope they expand this because drugs aren't cheap. Secure 2.0 passed as part of the Consolidated Appropriations Act, or the Omnibus Bill that just passed in December. It had to pass, otherwise the government would shut down. We're out of time, so I'm not going to go into detail. We can do another seminar on this because this made some significant changes in retirements. I'm going to just point out some highlights here. So the details. What does this law do? It changes the required beginning date for required minimum distributions for 2023. Instead of age 72, it's 73. So that's a big change. Also, it bumps up the catch-up limit if you're 60, 61, 62, or 63. Instead of $7,500, it's $10,000. There's a new tax credit for hiring military spouses, which I think is great. There's penalty-free withdrawals for certain emergencies. We always run into an emergency. My car breaks down. I need a water pump, or I need new tires, or whatever, but I don't have the money available. Well, see, the new law gives us some provisions for that. Also, there's a new exception to the early distribution tax, and that is domestic abuse. If you're a victim of domestic abuse, you got to get out of your situation, but you need to put a deposit down for a new place to live. you can take a small amount out of your retirement account without a penalty. You can also pay it back within 3 years, so you won't be taxed on it. The other really hot one I've been hearing a lot about from people are the tax-free rollover from 529s to Roth IRAs. Because of the pandemic, some of us have leftover money in the 529 plans because of the pandemic. And so you can roll over whatever's left in there into a Roth IRA with certain situations here. So we can do another seminar just on this whole Secure 2.0 here. Let's see. Okay, I think we're in pretty good shape here. Okay, I'm going to wrap up with California. So what's going on in California? We've had the middle class tax refund. So you should be getting your payments starting on October 15th. The last one is January 15th. So the last set of payments, if you haven't gotten yet. If you're getting a debit card, the last debit card should be coming out around February 15th or so. To get the middle class tax refund, it's not really a refund. It's money the state wants to give you. Originally, Gavin Newsom wanted to help buy some gas for us, and this is what came up instead. This only applies if you file a 2020 tax return by October 15th of 2021. You can't be claims independent. You have to be a California resident for at least 6 months, and you have to be a California resident when you get the money. So if you're deceased, you don't get this. You're not supposed to get this because you're no longer a resident. You're gone. So if you did a direct deposit for your refund, you should have gotten it as a direct deposit. So check your bank statement for that. Otherwise, it comes in the form of a debit card. It's not taxable for California purposes. You will get a 1099 miscellaneous from the Franchise Tax Board if you got more than $600. Here's a couple of links here for you to get more information about it. Here's a chart on the amount you expect. So the maximum is $1,050. That's if your income is $150,000 or less. You're married, filing jointly with at least one dependent. So the maximum is $1,050. But if you're single, if you make less than $75,000, that's $700. If you make less than $250,000, you get at least $400. So here's the chart of what the refund is. Here's a picture of what the debit card envelope looks like. A lot of people get them, they throw it away. Okay, you'll see the return address, California Middle Class Tax Refund, is from Omaha. Don't ask me. I think the bank's in New York. Why don't they pick a California one? So this is what the debit card looks like. There's some scams going on out there. So if you got your debit card and you went to cash it in and there's no money in there, call your state assembly member or state senator. Get their office to help you with it. Because there's some scammers out there somehow. They might just suck the money out of these before you even get them. So check very carefully. Okay. First time abatement, that's a thing in the California law that you can ask them to forgive a penalty. You only get it once in your life, so don't blow it. Student loan forgiveness. There's a little background on that. It's on hold right now. This slide talks about when a student loan forgiveness is not taxable for California purposes. Unfortunately, we don't have enough time to go over these details today, but we can do it at a different time. Okay, some new tax credits. There's the young child tax credit. There's the foster youth tax credit. If you had a baby this year, any baby born after July 1st, you get up to $100 in your Cal Kids account. So you can learn more about that at calkids.org. And San Francisco also has its own program. This is actually modeled after the San Francisco program because every kid in San Francisco gets a college savings account. So if you want to learn more about that, go to your school and they'll have a workshop on it. Cal Savers, that's the California Administered Retirement Plan, because not every company has a retirement plan. So we have Cal Savers. Employers have to register. We had a June 30th deadline if you have 5 or more employees. There's some nasty penalties if you don't do that. We also have the homeless hiring tax credit. We lead the country in homeless population. The number of homeless people we have is bigger than the average city. You can get up to $30,000 for hiring a homeless person. And you think, why would I hire a homeless person? Well, I used to work for a large CPA firm in downtown San Francisco, and one of my colleagues was homeless. Yes, CPAs. He was a CPA. He's homeless. He was living on the panhandle of Golden Gate Park. He had a van, and that's where he lived. He was homeless. He worked really hard, got a couple of promotions, and yes, he made enough money to get his own apartment. So he's no longer homeless. But yeah, he wears a black suit, white shirt, and a black tie. You would never know he's homeless. Anyway, you get a tax credit for hiring someone that's homeless. Yeah, it's $30,000. You can get up to $30,000. Depends on how many hours they work for you. So, let's see if we can help solve the problem with this, right? So, wildfires, yeah, California, right? So we finally had a law passed that says that if you have settlements for the Butte Fire, the North Bay, the Thomas Fire, the Woolsey Fire, the Camp Fire, some of those are pretty substantial settlements. They're not taxable for California purposes. So there's some relief there if you're a victim of the fires. So, okay, Ramon, I think that's the fastest hour I've had in my life.
Yes, thank you. That was a lot of
I'm
information.
so sorry if I talk too fast, but I'll stick around to go over some questions here. Let me just turn off
Yes.
slide. Okay. So I
So
guess we
we,
saw some questions flying in fast and furious.
yes, so the first one I think had to do with the losses for the try to find it.
Okay, do you want me to turn off the recording now, Ramon?
Sure. Yeah.
Okay, I'm gonna
thank
turn
you.
off the recording. Let me find the button here. All right. Okay, I'm gonna stop the recording.
Okay.
So